I want to ask you something honest. If you have ever bought a stock because someone online said it was about to explode, or sold your investments the moment the market dropped, or waited on the sidelines for the perfect moment to start, you have already made at least one of the mistakes we are covering today. And here's the thing, none of these mistakes are about being stupid. Some of the smartest people I know make every single one of them. They're mistakes that feel completely logical in the moment, which is exactly what makes them so expensive. Today, we're going through the 7 biggest investing mistakes beginners make, why each one costs you real money, and exactly what to do instead. Let's get into it. Mistake 1. Waiting for the perfect moment to start. The single most common and most damaging mistake beginners make is waiting. Waiting until they have more money, waiting until the market looks safer, waiting until they feel ready. The problem is that moment never comes. Here's what waiting actually costs you. Let's say you invest $5,000 at age 25 and never add another dollar. At a 10% average annual return, by age 65, that $5,000 grows to around $226,000. Now let's say you wait just 10 years and invest that same $5,000 at age 35. By age 65, you have roughly $87,000. Same amount invested, same return, the only difference is 10 years. That 10-year delay cost you $139,000. The market will always look uncertain. There will always be a reason to wait. An election, a recession, rising interest rates, some new crisis in the news. The investors who build real wealth are not the ones who time the market perfectly. They're the ones who spent the most time in the market. The best day to start investing was 10 years ago. The second best day is today. Open the account, make the first purchase, get in. Mistake 2. Trying to pick individual stocks. The second mistake is one of the most seductive ones out there, picking individual stocks. It feels exciting. It feels like you're doing something smart. You research a company, you believe in it, you buy in. And sometimes it works, but over time, the numbers tell a completely different story. Study after study has shown that over a 15-year period, more than 90% of actively managed funds run by professional investors with entire research teams and decades of experience, fail to beat the S&P 500 index. If the professionals cannot consistently beat the market, the odds of a beginner doing it over the long term are very slim. Think about it this way. When you buy a share of Apple, you're buying it from someone who's selling it. That person could be a hedge fund with 200 analysts who have been studying Apple's supply chain for 3 years. You're on the other side of that trade. In most cases, you do not have an information advantage. This does not mean individual stocks are always wrong, but for the money that represents your core long-term wealth, your retirement, your financial foundation, a low-cost index fund that tracks the entire market is almost always the smarter move. Save stock picking for money you're genuinely willing to lose. Mistake 3. Panic selling when the market drops. This one is the most emotionally driven mistake on the list, and it might be the most expensive. The market drops, your portfolio goes red, your stomach drops with it. And the instinct, the very loud, very convincing instinct, is to sell before it gets worse. Here's the problem. By the time you feel that urge to sell, the drop has already happened. You're not protecting yourself from a loss, you're locking in the loss permanently. And then when the market recovers, which historically it always has, you've already cashed out and you miss the recovery entirely. Let's look at a real example. During the COVID crash in March 2020, the S&P 500 dropped about 34% in just over a month. Terrifying. A lot of people sold. But by August of that same year, just 5 months later, the market had fully recovered and went on to hit new all-time highs. The people who held on made all of it back, and then some. The people who sold locked in a 34% loss. The antidote to panic selling is having a plan before the market drops. Know that drops are normal. Know that they're temporary. Remind yourself that you're not invested for the next 6 months. You're invested for the next 10, 20, 30 years. Zoom out. The chart of the stock market over the last 100 years is one long upward line with bumps along the way. Every single drop in history has eventually been erased by new highs. If you're finding this useful and you want content like this every week, please hit the like button right now and subscribe to this channel. Invest if you haven't already. It makes a real difference, and it means I can keep making these videos completely free. All right, back to the mistakes. Mistake 4. Ignoring fees and expense ratios. This mistake is invisible, which is why it makes it so dangerous. Most beginners never even look at fees, but over a lifetime of investing, fees can quietly drain hundreds of thousands of dollars from your portfolio. Here's how it works. Every fund charges what's called an expense ratio, a percentage of your investment taken out each year to cover fund management costs. A 1% expense ratio sounds tiny, but here's what that actually means over time. Let's say you invest $10,000 and earn 10% per year for 30 years. With no fees, you end up with around $174,000. With 1% annual fee, you end up with around $132,000. That single 1% difference cost you $42,000 over 30 years. Now compare that to VOO, Vanguard's S&P 500 ETF, which charges just 0.03% per year. The difference over a lifetime is staggering. When you're choosing funds, always check the expense ratio before you buy. For index funds, anything under 0.10% is excellent. Anything above 0.50% should raise a serious question about whether that fund is worth the cost. Most of the time, the answer is no.
Mistake 5 is classic overconfidence. You find a stock or sector you believe in strongly and you go all in. Maybe it's a tech company you love. Maybe it's crypto. Maybe it's your employer's stock because you work there and you know the product is great. And sometimes it works beautifully, right up until it does not. Enron employees had 60% of their retirement savings in Enron stock. When the company collapsed in 2001, they lost their jobs and most of their retirement savings at the same time. The company seemed rock solid from the inside. It was not. Diversification is not about being pessimistic. It's about being realistic. No single company, sector, or asset class wins every year. By spreading your investments across many companies, sectors, and even countries, you ensure that no single failure can wipe you out. An S&P 500 index fund gives you instant diversification across 500 companies in one purchase. That's one of the core reasons they're so powerful for beginners. Mistake 6 is checking your portfolio every day. This one sounds harmless. What's wrong with keeping an eye on your money? The problem is what daily checking does to your decision-making. The stock market moves up and down every single day. On any given day, there's roughly a 50-50 chance your portfolio is in the green or the red. If you check it every day, you're going to see red about half the time. And every time you see red, your brain registers it as a loss, even if you're up significantly for the year. This emotional roller coaster leads people to make reactive, emotional decisions instead of staying with their long-term plan. Research from behavioral finance shows that investors who check their portfolios less frequently consistently achieve better returns than those who monitor them constantly. The best thing you can do for most of your long-term investments is set up your automatic contributions, check in once a quarter to make sure everything looks sensible, and then leave it alone. Investing is not a sport that rewards the most active players. It rewards the most patient ones. Mistake 7. Investing money you might need soon without an emergency fund as your safety net first. This final mistake ties directly back to what we covered in video 1, and it's worth repeating because so many people skip this step in their excitement to start investing. Investing money you might need in the next 6 to 12 months is not investing, it's gambling with your financial stability. The stock market can drop 30, 40, even 50% in a short period. If that happens and you need that money for an emergency, you're forced to sell at the worst possible time, at a loss, with no choice in the matter. Your investment account should only ever contain money you genuinely do not need for at least 3 to 5 years. Before you put a single dollar into the market, make sure you have at least 1 month of essential expenses sitting in a high-yield savings account that you can access immediately if something goes wrong. Build that cushion first, then invest everything above it. That's the order that protects you. 7 mistakes. Let's run through them one more time quickly so they stick. Mistake 1. Waiting for the perfect moment that never comes. Mistake 2. Trying to pick individual stocks against professionals with vastly more information. Mistake 3. Panic selling when the market drops and locking in losses permanently. Mistake 4. Ignoring fees and expense ratios that quietly drain your returns over decades. Mistake 5. Putting too much money in one place and leaving yourself exposed to a single failure. Mistake 6. Checking your portfolio every day and making emotional decisions as a result. Mistake 7. Investing money you might need soon without an emergency fund as your safety net first. The good news is that every single one of these mistakes is completely avoidable once you know about them, and now you do. I've linked some excellent resources in the description below, books, tools, and guides that go deeper on everything we covered today. If you're serious about building your financial knowledge, those are worth your time. If this video helped you see something differently, drop a comment and tell me which mistake hit closest to home. I genuinely read every single one, and I would love to hear from you. And if you haven't subscribed yet, now is the time. New videos every week, always free, always practical.
Check out the next video because it will help you keep building a stronger financial foundation and avoid mistakes that could slow down your progress.